Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is January the 22nd, and Brent crude oil is trading down a little bit this morning in Asia at $78.24. WTI is about $5 back from that. And there is we come sort of to the last week of trading in January, a month in which the bandwidth for oil has been pretty tight, $2 more or less, between kind of 75 and change and 78, or there 76 and change and 78. But nonetheless, a pretty tight bandwidth. Omar Najia, Global Head of Derivatives of BB Energy. Is this market likely to continue in this sort of stable, no pulse through February as well, or what's your outlook?
Look, maybe, but I think we're coming up to the end of January, so we've got to start doing something. So we're buying. So you have to do something at some point. You can't just sit and on the sidelines and watch. So I think WTI has like a little burgeoning uptrend. If you look at the price action, basically it's definitely sideways, but it keeps having these lower, what we call lower wick. So like a body of a candle is like, nice and juicy and fat, but it has like long lower wicks, which means that people don't like selling or holding on to shorts below $70. So we are long. We want to get longer, and I think it's we're seeing the same kind of pattern for risk assets, namely Bitcoin. We're seeing the same kind of thing for equities. We're seeing the same kind of thing for GBP against USD, for Euro against USD. So I think it's, markets are going to make a big move to the upside, those ones. So I think oil higher, Bitcoin higher, and I think GBP against US higher, Euro higher, etc. So we are officially bullish.
Andy Lavin, senior partner at Econs. Andy, your thoughts on the outlook? I mean, we've had a month in which, from a neighborhood point of view, the traumas in the Red Sea and the disruption to global shipping lanes, and yet the oil market seemed to be unconcerned. Meanwhile, as Omar points out, the equity markets are on a tear. I think we hit a record on Friday on the S&P Dow Jones, which obviously is a forward-looking outlook this equity markets gives us. So they're pretty optimistic about the year ahead. The oil market's less so. How do you square those two circles?
So I think, to some extent, I agree with Omar. The bit I would say is that in terms of the geopolitics, as it were, I think it's too complicated for people to get their heads around. They don't really know how it's going to play out. So let's just fall back on simple supply and demand. And that's kind of where we are today. Nothing's really changing supply demand. There's a little bit of concern in terms of the demand, but I think what's driving the positivity that Omar's talking about is the expectation that the governments will have to intervene if the world doesn't turn positive all by itself. I think we've seen so much almost bad news going back to COVID times that the whole world wants to come out the other side, and therefore there is an element of expectation about positivity. but it's continually dampened by things like demand issues and oversupply and geopolitics and all kind of complicated stuff that is really difficult to get your heads around.
Bora Barryman, managing partner, Homer Straits Partnership. Bora, it feels a little bit like, you know, when in doubt, the market wants to go up. I mean, that's the risk markets. We saw in the fourth quarter a massive end of year rally on the back of the somewhat sort of bearish outlook by the Fed that the end of the tightening cycle was over, and there was a big optimistic outlook that there was going to be 6 or 7 rate cuts in 2024. And so the market rallied. And in January, we've had the opposite. We've had a sobering up, the realization that inflation's still around. The Fed are giving strong signals that they're going to be higher for longer. And yet the market still rallies. That, the opposite news on rate outlook, and the market still rallies. What's your analysis on those two contradictions?
Indeed, there's a big contradiction there, and it indicates the outlook for more of what we've had, I think, over the past few years. A lot of volatility, and you know, there. I see these market rallies as indications that the market expects some type of quantitative easing or some type of liquidity injection into the markets that will go into the components of the index. You know, this is the top of the food chain. Players like Amazon and Google will get their valuations pumped up, but I don't see much in the way of a broader growth outlook for profits in the majority of companies in the real economy.
Omar, you sort of put your chips on the table, so to speak. Obviously, you've been advocating a bullish posture for a while now. You've put your money on the table. What's the sort of the magnet pulling the long position? We have, you know, lots of supply. We've even overnight the news that Libya's largest oil field is coming out of force majeure closure, adding 250,000 barrels that has been off the market for the last month. There's kind of, you know, quite a bit of supply, idle supply around, and not necessarily very strong demand outlooks. China, the biggest oil importer, signaling continued sort of uncertainty there. Where do you see the sort of the long hook to hang your hat on?
So yeah, I mean, look, the stuff with Libya, nobody expects if basically there's something happens and they pull supply that it's never going to come back. So again, it doesn't matter. The stuff with China, there's a lot of negativity in the market, and I think basically, honestly, I've been hearing about China since COVID, that they're dead, they're never kind of, and nothing's happened. So China I discard completely. But I think basically the problem is not the problem, but the real in the quote unquote real economy, right? You have the US running a $2 trillion deficit, $2 trillion, 2,000 billion, right? That is not deflationary, and that is not going to cause a recession, whatever people think. And even if you have interest rates now at 5%, or even if they go higher, it's not going to cause a recession. A lot of big companies basically sold their debt at less than 0.5%. So I don't think small firms maybe, but I don't see where the risk of basically a downturn is going to come from. And I think you're seeing the S&P get to new highs. I think we're going to go substantially higher, 5,900, something like that. I think it's an election year. There's wars happening, in Ukraine. There's a war in Gaza, maybe now in Lebanon. These are not deflationary things. These are basically spend. So when it comes to oil, basically, it's a question of not so much, China is doing this much and demand is 1 + 1, all this kind of stuff. But all this money that's there has to find a home, like us. I'd love to basically sit and do nothing for 12 months. but you've got to use your chips, right? So if you have your chips and you
You
want
got
to
to
use
earn a
them,
crust.
yeah, you got to basically bet on the upside. So that's what's going to happen. People now are incredulous. No, maybe not. Let's see. Is it really worth it? Blah 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 blah. But the more money comes in, money flow is going to rule. Money's going to come in. Markets are going to go up. Even more money is going to come in. Markets going to go up. And then people who haven't bought are going to say, "Oh shit, we might as well buy now," and that market's going to go up. So I don't see the justification for here we go, and it's going to be really bad and recession. There's just too much money. There's just too much money. Even the market is saying that the Fed is going to cut interest rates, and the Fed can't do anything. If they cut interest rates, it's inflationary. If basically they raise interest rates, it's inflationary. Why? Because there's so much debt. They're paying so much in terms of interest on that itself is inflationary. There's even more money in the economy. So the US is trapped and the world is trapped. The only question is, at what trajectory, do we go up this way? Do we go up vertically? And I think that's also an expression what Bitcoin is trying to say to the market. The only question is how high and how fast. So I like these markets. We wanna buy more.
Andy, you have the luxury of not having to sit at the edge of your seat every day now trading this kind of market. But you would say, given the start of the year with all of the context, OPEC should be quite happy at the moment. The oil suppliers, the oil exporters, $78, $77, $76 average in January, the sort of weak window of the year is promising the outlook. How do you think OPEC sits at this time, looking at all that's going on in the market balance?
So I think OPEC are probably a little bit worried about the US because, the US is increasing their production and arguably becoming more dominant in the market certainly in terms of just the absolute supply they have. I think for many of them, even this is probably a little bit lower than they'd like it to be. You look at the expansion plans in Saudi. There's no way that oil price at this level can create the cash flow they need to do what they want to do. So I think they will be concerned to the downside. I think for all the reasons Omar said, there'll be some positivity. Coming back to the question you asked, Omar, to me, it's the other way around. I don't see what the hook is to short side. There's a lot of talk, but there's nothing. It's just well, it's probably not very good, but actually it should go up, right? So to me, it's just there's no real impetus to the downside. So that will be positive to OPEC. I think there will be a whole conversation going in the background with people leaving. Is Russia really committed to OPEC plus? How much, as we kind of continue to mature, which is a bit of a bizarre thing to say about an oil industry that's been around for decades, as we continue to mature, how does OPEC retain a purpose? Because inevitably it will change. It will change either because the West stop pumping in the long run, or the West keeps pumping, and therefore the percentage that OPEC has becomes less. So it's a real challenge for them in terms of the long term. In the short term, I think you're right. They'll be kind of okay, but I wouldn't have said comfortable.
Bora, perhaps Andy doesn't see short optionality because he sits in the luxury of Dubai, and certainly everything does seem very positive here. But if you were sitting closer to Sunderland like you are, or some other British city, you might feel that this is a market to short. Your sense of where that sort of macro outlook is versus, it's malaise, it's not. How do you see that quantitative easing? Is there any money left in that British exchequer to pump?
No, I think, as you pointed out, the UK is in a particularly difficult conundrum because we had the inflation report last week, which came out at 4%. Actually, it went up. The rest of the world is talking about disinflation. That's a new word I learned last year. It's not deflation, but it's disinflation, whatever. But the UK inflation is going up. It's zigzagging. And Andrew Bailey, the leader of the Bank of England, he indicated that the growth outlook is also very poor for the UK economy. That's
And for
certainly not
Europe as a
something to
whole,
buy.
right?
UK and in Europe is a funny place, hard to interpret what the ECB really wants to accomplish, because they have been successful in disinflation, reducing the rate of inflation, but Germany is no longer the motor. Germany is a laggard, and I think fundamentally, as you said, it depends where you sit. America looks um, like it is the master of its own destiny. Whatever they choose for themselves, they will be able to accomplish. Asia is experiencing a industrial and intellectual revolution and gaining more confidence by the month, I would say, and it needs to do that quickly as well, because they realize now that the existing world order led by America doesn't look out for them. But for Europe and the UK, I was impressed by the speech that many other people panned, but I was impressed by its directness. The speech of the UK's Minister of Defence, Grant Shapps, last week, where he just very boldly said that he sees the rest of this decade being one where theaters of conflict multiply around the world, from the Middle East and Ukraine to other areas of the world, and that the era of the peace dividend is over. That's what, the peace dividend that W. Bush's father, George Bush, promised us all, a peace dividend at the end of the Cold War. That's over, and that 2024 is an inflection point. So that, to me, it means that there's not a lot of spending on public services and social programs. Certainly, governments will be looking to raise taxes in Europe where they can, and the United States and particularly Donald Trump have been wagging a very bold finger at the Europeans, saying you must spend more on your own defense. You can't rely on us. So that will mean a sort of rebalancing or reallocation of resources from the social sectors to the defense sectors. It will be very bullish for certain, perhaps industrial interests, the military industrial complex. But I think at the end of the day, it will squeeze the European consumer.
Omar, I mean, buy defense stocks by the sounds of it. I mean, the one of the interviews or panel discussions I watched last week at Davos, speaking to Bora's point, was with the finance minister of Germany, and he was asked about how should Europe prepare for a possible second Trump presidency. And one of the things he said was, make sure we get our NATO payments up to date, the 2% average, if you like. I mean, as you point out, all of these factors are inflationary.
Yeah, man.
They are, yeah.
Omar, yep.
Go ahead, Omar.
So basically, look, if I mean, Germany's worried about the wrong thing, right? So they're deindustrializing. You have the rise of the AfD, which is a right-wing party. So, and the reason is that basically Nord Stream, they used to get gas so cheaply that they used to basically have a multiplier, which was like, they used to pay like, I think, like $20 billion for gas. And they used to leverage that up to $2 trillion of sales. So, that's gone forever. Forget about Germany and forget about basically what those ministers are saying. Whatever the whole government.
Well, also when you combine to that the technology deficit that they have on their critical export product of automobiles, I mean, regardless of the price of energy, they've just missed the boat on EVs. I mean, whether energy is $1 or $100, they've missed that boat.
Yeah, but basically what happens is they become uncompetitive. Germany, Europe, the UK, all their economies are suffering because of all these sanctions, right? So who's benefiting? You have Russia and you have the US. So, I mean, it's really simple, and this is why you'll see all these governments in Europe basically get thrown out, because obviously, the people there are feeling the pinch. So in terms of that's the problem basically when you have an empire basically that's failing. You get basically the US that eats everybody else. It eats all its children. It eats the Europe. It eats the UK. Blah blah blah. In order to survive longer and longer. So in terms of anything to do with investment going forwards, the US has really massive problems. It has massive fiscal problems. Debt to GDP is 120%. You have de-dollarization, which has started. And basically, if they confiscate this money, if they actually take the money they've confiscated, if they actually take the money,
I suppose it's at some point, we all have to say the king has no clothes. Until that day, the dollar has value. I suppose in one moment to the next, it doesn't. Andy, I just wanted to pick you up on the point you made earlier that the market turns back to the fundamentals of supply and demand. And yet, at the same token, obviously, you're indicating that there is that it's not a market for shorting. There's no reason to short this market. But if you take the analogy of the basics of supply and demand, this market should be lower. No, I mean, there's 5 to 7 million barrels of idle supply in the market. It would take a major moment to see where a deficit would come from. I mean, on that point, the geopolitics is keeping this price up.
No, you are absolutely correct. I think that the reality is I don't remember a reasonable period of time in the history I've been in the oil industry where oil was priced at effectively what it should be priced at, which is the next marginal barrel. Typically, it's always moving around because of other stuff. I think it is just the reality is that there's an enormous number of participants in the market, and essentially the price goes where the average person in the market thinks it should be. It's driven by lots of things. Fundamentals is one of them. Fundamentals, to me, puts a floor or a cap on it. Doesn't actually necessarily set the absolute price. What sets the absolute price is emotion. And that's kind of what Omar's talking about when he talks about technicals. It's actually just the technicals give you the sense of where everybody is, given that nobody has all the information, nobody has all the news. It's just the emotion of the market. So to me, the fundamentals create the shape, but the absolute level is just kind of where you want to sell, where you want to buy. It's a bit like, how do you value a car? Well, it's how much does somebody want to pay for it? It's almost as simple as that.
I mean, one of the more profound statement, insightful or guiding statements in January that I've heard in the beginning of the year was from Mike Muller in our Global Energy Outlook Forum day, when he said, it's been a long time that there's been so much oil available from so many different places, all at the same time. That's certainly a sense of this market at the moment.
No, I think that's absolutely right. Although it's available, that doesn't necessarily people want to take it. So you take Russian oil, for example. If you look at the totality, we've got plenty of oil. However, some of that oil is in the wrong place and is going somewhere that actually economically it shouldn't be going. And that's because of the sanctions, right? So the sanctions will have an impact on the oil market. They were never intended to cut Russian oil out. They were intended to reduce the amount of revenue that went to Russia. The consequence of that is that the flows have changed and therefore the pricing changes. But
not necessarily an efficient,
but not necessarily what people want to buy.
Let's take the survey question, which is reflecting on the point of rates. The dampening outlook on rate cuts coming in first half of 24 will be bullish or bearish for oil prices. The idea that a few weeks ago there was a market expectation of a massive 6 or 7 rate cuts in 24 which in order to get to that number, you'd have to have a depression, never mind a recession. And that's hardly good news. But the dampening outlook on rate cuts coming in the first half of 24, i.e. they aren't going to happen. Will that be bullish or bearish for oil prices? The fact that the price of money will remain higher for longer, is that bullish or bearish for oil prices? Your thoughts on that question, Bora, and where that goes from the point of view of, as you mentioned, the UK central bank's views on the market at the moment. The Fed came out quite strong. Well, one of the Fed officials, San Francisco Fed, came out over the weekend, sort of once again hammering the point the market's got ahead of itself. What do you think is the outlook of where rates go now and the market's alignment and what it means for oil prices and the oil demand, if you like?
I think at least in the US, the Fed would like to keep the rates at this level for as long as they can. And they were looking for a soft landing, and clearly the US has landed on a bed of roses because they have this Biden election pamphlet headlines. Unemployment at lowest rates ever, basically in the 3.5% range. I've never heard of that in my life. That's fantastic for America. Inflation at around 3.5%. It's better than the UK. They can say we're doing better than other major economies. And there's just a lot of public spending going on with.
So where do you think the market, Bora, where do you think, I mean, I was quite confused as to where the market got that expectation of that scale of rate cuts. I mean, what was that? What house was that built on? What stack of cards were they putting on top of each other to come to even 4 bet cuts, never mind 6 or 7? I mean, what's the logic there?
I think there is certain pressure on levered areas of the economy, particularly sort of this commercial real estate concern that's been out there for some time. I've been hearing worries about major commercial real estate portfolios in the US for quite a while, and the American consumer remains quite levered. But I think something's happening there. I'm not sitting in the US, but there's some generous restructuring terms
ultimately
there.
I think they would have to be seeing some massive unemployment coming in the headlights that they were going to try and get out in front of in order to make those amount of rate cuts.
So the point is that there is, plenty of buffer to handle any major shock, at least to the US economy. They've got 5.5 percentage points they could cut to get to where they used to be at free money. And we're having a war in the Middle East, and it's proliferating around the world. And the UK's defense minister officially says he expects these conflicts to proliferate around the world. That would be bullish for oil prices, but it's not having much of an effect. And certainly at the moment, the Fed is going to keep rates higher for longer, which leads us to believe that the rate policy isn't going to help the oil price.
Omar, your thoughts on that as a closing comment. Does it matter if the Fed backs away from the market's expectation of cuts?
Okay, so basically the Fed right now is paying $1 trillion for defense and $1 trillion on interest payments, right? That's $2 trillion, right? So the Fed is stuffed like, better than a Christmas turkey. The Fed is going to cut rates because it cannot afford either to keep them where they are, especially because it has massive debt issuance that's to come. And it's going to cut rates because it wants to cut that trillion, because that trillion is just going to go up simply based, if it keeps rates where they are, on the debt issuance that's coming. So the Fed is going to cut, S&P is going to rise, oil is going to go up. Inflation is what they say it is, right? They can just make up the number. Make up the number how? By deciding what's in the CPI, right? So we take out energy, we take out schools, we take out everything, but we keep the price of a loaf of bread. So no, I think basically the Fed is going to cut. I think the market knows that the Fed can't raise rates, that they have to cut. And it's just a question of time. And I think this is what you're seeing the markets front run that. You're seeing the S&P front run that. You're going to see tech stocks front run that. And I think, the markets are inflationary. So the USD is going to head lower against other fiat currencies and against basically the price of oil, the price of other commodities. And OPEC now is transformed. It's gone from OPEC plus to BRICS, right? So all the major oil producers are members of BRICS. And I think what you're seeing is a complete shift.
And the major oil consumers, i.e. India and
Yeah,
China.
yeah, absolutely. But I think basically what you're seeing is you're seeing that pricing power, that narrative control disappear from the West. And don't forget, these guys, so we're playing with the price of oil, buy a little, sell a little, make a little bit of money, lose a little bit of money. These guys, the Russia, China, US, Europe, well, they're playing for like the globe, right? And it's all shifted. It's gone basically to the side of the BRICS. So I think that means basically that OPEC becomes BRICS and becomes higher oil prices simply because the West is a consumer. So higher oil prices, higher commodity prices, all that kind of stuff. And
I have to say, on the rate side, I would just wrap up as I don't see how the Fed cuts from here unless without unemployment being significantly challenged. This is an election year in the United States, and the last thing the Fed needs or wants to do is jump into the middle of supporting what could be a very, unless there's very hard evidence to support the sitting president versus the Trump candidate. I mean, it's just a messy place. You're going to have to need some hard evidence to jump in the middle of that fight and say, yellow card, 3 basis points or 3 cuts down. That's my sense. It's not so much the dynamics, but the politics now are a big factor. And you're going to need really hard evidence if you're the Fed to jump in the middle of this fight. That's my penny's worth. Andrew Lavin, lovely to see you. Welcome back. Happy New Year. Omar Najee, as always. It's not Monday morning unless we get a good bark from Omar. Bora, thank you so much. Oh, just dropped off. It's like a collapsing market. Bora, thank you so much. Have a great day, week, everybody. Catch up every morning, 10:30. All the best.
Thank you very much.
Thank you, guys.
Thanks, guys.